This is System Trader Show, episode number 9.
Welcome to System Trader Podcast. Listen to interviews with top traders and find out how the most successful traders beat the markets and what are the secrets of their success. This is System Trader Podcast with your host, Jack Lempart.
Andreas Clenow is a Chief Investment Officer located in Zurich, Switzerland, overseeing many investment strategies over a 9-figure asset base. In today's interview, we focus mostly on his work within a quant hedge fund. We are covering many topics, including trend-following strategies and equity momentum strategies. You can also find out why trading your own money is not always the best option to do so. Andreas is an author of international bestsellers titled Following the Trend and Stocks on the Move. These books present a quantitative approach to modeling the markets with extensive backtest results. You can also learn from the practitioner how hedge fund business looks from the inside. No worries if math or statistics is your Achilles heel. As Andreas says, scientific papers often are unnecessarily obfuscating the knowledge so that it's not easily accessible to everyone. He proves it doesn't have to be the case, explaining complex things as we could think in an easy way. For more details on this episode, please visit my website at systemtrader.show/009, where I put the show notes. I hope you will enjoy the show. Hello, Andreas.
Hi, good morning.
Good morning. Thank you for accepting my invitation to the podcast. I have a pretty long list here with questions, so let's get started. Could you please tell us a bit about yourself, about your career, and how it happened that someone who started, as far as I know, in the IT sector, programming to be specific, which is very lucrative, by the way, decided to move eventually into the financial sector?
Well, the IT part was back in the mid-90s. I started with that. Not so much programming, actually. I did a little bit of that, but that was not the main thing back then. For those listening who are old enough to have been part of it, the 90s was a very strange time in terms of knowing computers. I was in university at the time. I was studying University of Gothenburg at the School of Economics over there, up in Sweden. And, I remember clearly when it happened. Like in 94, nobody wants to hear about computers. 94, computers was, if you were pretty good at computers, you kept it to yourself at universities. It's not exactly a cool thing in 94. 95, it's kind of slowly started to change. In 96, your grandmother asked you what modem to get. Suddenly it just exploded. Suddenly people who wouldn't admit that they owned a computer in 94 were suddenly talking about bit rates on modems, internet connections, email addresses. Everything just exploded overnight. And the knowledge that guys like me had back then, which kind of seemed like a almost useless hobby in 94, turned into something that was just, everybody needed it. Everybody, everywhere. It was just simply too easy to make money from it, to leave it on the table. So I started a company back then, like a lot of other people I knew. The situation is a bit weird to imagine these days, because companies everywhere suddenly realized they need computer knowledge, and they had none, zero. The average company, they had no idea which direction to point a mouse. I had clients who put the cable of the mouse facing the wrong direction because it looked more like a mouse that way. Now from there to explain what is the internet, how does it work, in beginning very simple stuff. It got more complex as things matured quickly. In the 90s, I was doing some computer security consultancy, stuff like that, hardening networks, stuff like that back then. Network was the big cool thing back then. It's hard to imagine now when, network engineer guys like an accountant, but back then network engineer guys were the coolest around. But after all, I did study economics, finance, and I'd say back in, what was that, late 99, something like that. I thought that it was this whole thing was kind of fun and profitable to be in the IT business, but it didn't seem like a grown-up thing to be doing. Somehow this didn't feel like a proper thing. It didn't feel like, you should be doing this forever. So I figured it's time to exit this and divest and get a proper job. And this was in no way any sort of foresight into what happened with the IT crash, all of these things, but rather dumb luck. I just thought it was time to grow up and get a job and see what that's about. And I got a job as I was head of Nordic division of Reuters Consulting. That's part of a company that doesn't exist anymore. We were doing quantitative models for banks and asset managers, these kind of things. So I had a Nordic team traveling far too much those days. What happened then? Well, it's been a while. I spent 5 years in total with Reuters. I advanced quickly for various strange reasons, and I found myself in Geneva on a business trip and realized Switzerland is, well, you wouldn't think it. Nobody plans to move to Switzerland, but once you're here, you realize that why would you want to live somewhere else? So I kind of stuck around. That was almost 20 years ago now. Yeah, I had 5 years in management career back in Geneva and Reuters, and for various reasons, I got disillusionized and tired of the whole corporate world. It's not specific about Reuters. I think corporate world is corporate world, and it's not for everybody.
Right.
And I decided to leave that. I started an asset management hedge fund firm, and well, I went from there.
All right. Thank you for that, Andreas. Very interesting. But I guess that you started your first trading in the 90s, not as a professional trader.
Yeah.
So I'm just wondering how you evolved over time, how your approach to trading was changing over time.
Significantly. I think I started similarly to a lot of other retail traders. That might seem strange here, but that's unusual in the business. Most people I know who are at a reasonably high level in the business, they never started as retail traders. So they lack that perspective, for better and worse. I started very much like most people listening here, I guess, with pretty much zero knowledge, a lot of enthusiasm, and did all the wrong things, like most people do. I got lucky though, because I started trading in the mid-90s. Of course, I had great profits. Almost everything I bought had great gains, and I thought I was really clever. It wasn't until long after I realized that my strategy was basically to buy tech stocks in a tech bull market. So, how bad can it go, right? But quite lucky. Not only that I made money on it, because clearly I did, me and everybody else, right? Every other idiot buying tech stocks in the bull market made money on it. Now, I was lucky in that it was fun, right? Because if I had started trading in 2000, 2001, I would probably have lost money again and again, and it simply moved on to another business.
Yeah.
So in that way, I was lucky.
Right. But how your trading changed since then? I mean, because you were more like a discretionary trader at the time, and then you slowly moved towards the quant approach? Yeah.
I mean, back then I was a total amateur, of course. I was buying, on any silly thing. I was reading all the technical analysis books without any critical thinking. I was drawing lines all over the place, throwing in 20 indicators, running this silly optimization programs. I was doing all these things, right? I mean, I even had a phase where I went through all this. I read books about wave theories and Fibonacci numbers and all of this total nonsense, like most people go through this. But if you come from that background, you kind of have to go through this and find out for yourself what is ridiculous nonsense and what's not. So yeah, there was no real structure back then. I tried everything. I did all the cliche things. For a while there in the 90s, I was printing a large amount of charts every day, taping them up on a big wall. Yeah, I was a fun guy back then. I had a wall full of charts. I mean, actually physical printed charts taped to the wall. It seemed like, something that you should be doing. And that's sometimes the problem, when you start out. You do things that seems to be, things that make for good stories 20 years later. And somehow you think that you're supposed to be doing those kind of things. No, it didn't help at all. Well, what happened? I think after some time, I realized that my tech knowledge could be very much applied to finance. I think that was the breakthrough in the end. I could combine different type of knowledges and construct proper models, approach it from a more scientific point of view, and actually testing hypothesis and building something more from a more scientific point of view.
All right. As we may have listeners who are not so familiar with quantitative approach, or maybe some people are not even aware of its existence, could you please explain why it may be superior over an approach which we oftentimes we can observe in the media or internet, where people are constantly struggling with how to interpret, for example, the news? You even mentioned in your book, I remember, where you said something like the financial news can be quite comical. How do you see systematic approach to trading? Why it's better in your view than the discretionary approach?
Oh, it's not necessarily better. I mean, it's different.
Yeah.
Both can be done in a good way and in a bad way, I would say. And which route you want to pick, it depends very much on your personality, what you want to do. But you need to have some sort of overall strategy that works and that fits into how you want to operate. I know some extremely good discretionary traders, some people who are performing amazing results, and they can barely begin to explain themselves what they do. We have the funniest conversations sometimes trying to explain to each other what we do for a living. And we're just talking very different languages. Now, I prefer the quantitative part for multiple reasons. One, it fits my disposition, my personality. It's a way of working I like. I can spend a lot of time researching and building something, and more or less not running it automatically. Nothing is really unattended. Automated does not mean unattended, as the expression goes. But it's a way of thinking that fits my personality, as opposed to, another guy might prefer to look at the screen all day, looking at the order depth, the ticks coming in, the order book, making fast decisions on the fly, trading in and out, back and forth in minutes. That's not really what I want to do. And I don't want to be tied to the screen, staring at the market data screen all day either. So, you pick the kind of life and the kind of business that fits you.
Right, I understand. But are your strategies, the one used in real trading, complex and difficult to understand comparing to what you showed, for example, in your books? We'll get to the books in a while, but is it something more or less what you showed in the book in your real trading?
Well, real trading always gets a bit more complicated. The details of implementation and transferring even a simple trading model into something, into a production grade model, can make it a bit more complicated. But I generally prefer simple concepts, more long-term concepts, keeping every part quite simple. You might combine many different things that might, in a way, create a more complex model on a higher level, if you wish. But every single model is fairly simple from a logical point of view. And I think that's a more robust way of working, to find an easily explainable concept, what you want to trade, and then model it in a simple way, usually long-term, from my point of view anyway, medium to long-term. It's really not that complex from a mathematical point of view. I'm not the machine learning guy. I'm not the artificial intelligence. There's a lot of buzzwords going around. Some of them matter, some don't. But there are people who are considerably more mathematically or technically complex than I am. But it fits their personality, and good for them.
Right. Okay. And what level of long-term annual profit and risk do you aim to achieve in your trading?
This is an important question, because I see a lot of misunderstandings on the retail side on this. There is the people who are not working in the industry, or what's realistic and what's not. I have discussions sometimes with some friends in the business, some who also wrote books on what's realistic. And this might surprise, but I had a discussion recently with a guy in the business I have great respect for, who wrote books as well. I think I mentioned that I believe realistic long-term results over long term might be maybe 15% annualized. Right. His point of view was that I was totally wrong, that 10% is more realistic in his view. Mm. And we had a long discussion about where in between the span of 10 to 15% is more reasonable. But this is the kind of span where you can have a reasonable discussion. On the other hand, I spoke at a conference half a year ago where there were only retail people in the crowd. I asked, as I often do, but what people expect from the market. And much to my shock, there was a general consensus at this conference that a good trader makes about 20% per week.
Per
week, yes. And
Right.
I realized that when I tried to explain this, the more I was trying to explain realism, the more I was digging myself into a hole, because the more people just disregarded me as, the idiot who can't make money. I tried to ask people if they tried doing the math of 1.2 to the power of 52, multiply that by their trading account. Nobody got the point. I explained, what would happen if you start with 10,000 at the beginning of the year. You have 130 million at the end of the year. But,
Right.
People miss such points, because then the counter argument from the retail crowd who read some of the weird books and blog posts and so on, they will say that, yeah, sure, but you don't compound it, right? Because you take out the gains. You do 20%, you take it out as living expenses. I say, well, why would you? Oh, come on. You can make from 10,000, you can have 130 million in a year. So why would you take out money? Live in your car in the street. Do what you need. If you can do that kind of magic, then do it. No, it's realistic returns, I would say 10 to 15% over time. I mean, any given year, anything can happen, right? You might have 80% gain one year. Who knows? If you have a very risky strategy. But give it 10, 15 years, and then you see where you average. And I really don't care what kind of absurd claims that some people are making out there. Realistic returns from trading are in these kind of ranges.
All right. I understand. Thank you for that, Andreas. As a chief investment officer, what level of asset under management do you control at the moment, if I can ask?
Sure, you can ask. I'm not going to give you an exact number, but say we are, well, how can I be fussy enough? We are north of $500 million. So we are medium size, I would say, for the business. We're certainly not large, we're not small, but medium size.
Right. I know that you also have products for so-called qualified accredited investors. You cannot simply promote such investment products in public without special legal considerations. But could you please very briefly explain who is or can be a qualified investor? So if someone there is listening and doesn't even know, if you could just say a few words about it.
Sure. I mean, first of all, we only deal with either institutions, financial institutions, or qualified investors. The term is slightly different jurisdiction. It's qualified or accredited, depending on where you are in the world. The legal definition varies slightly as well, but roughly speaking, in most jurisdictions, you are qualified or accredited if you have a liquid net worth in excess of $2 million equivalent, not counting real estate. So in that kind of range anyway. And then the rules usually change a little bit. It is a whole different type of game to target retail. If you want to have a public product where you want to, anybody can invest $100 or $1,000 or $10,000. That's a very different business than if you deal only with, say, multimillionaires who can invest $500,000 or say half a million or more in a single ticket size.
Right, I understand. Okay, thank you. I would like to ask you a few questions more about the professional trading and retail trading. Why trading own money, being a retail trader, is a bad trade? Because you published an article on your website explaining why managing own money is a bad trade. Could you please share with the listeners what you meant exactly by saying that?
Sure. Let me first qualify it a little bit and explain the context. What I said was not that it's a bad idea to manage your own money, but rather it's a bad idea to manage your own money for a living.
Right.
Obviously, I wrote this article slightly to provoke, but I'm trying to make a valid point here. Thing is, if you're not keeping in mind that realistic returns, in my view, is 10 to 15% a year. Maybe a little bit higher if you're prepared to take a larger risk, but you're not going to get triple-digit returns. I mean, not over time. That's nobody does that, not on trading. But if you trade for a living, your own money only, You take all the risk, and you have all the upside, you have all the downside. Now, if you compare that to trading other people's money for a living, as well as your own, you have a very different risk profile. So if you trade your own money for a living, you have no other income. So you're going to be forced to take on a lot of risk. The only way you can get higher returns is to bump up the risk and hope for the best. And that usually ends badly. So if you aim for ridiculous high returns, 50, 60% a year, you must be prepared for a very high risk. So you might make money for a year, maybe two, and sooner or later you blow up and your money is gone. And you can't even compound the money because you're taking out living expenses. On the other hand, if you trade other people's money for a living, you can trade your own at the same time, but if you trade other people's money as well, you get a base fee for doing so called a management fee and or performance fee, depending on the structure of your business. But now you can do what you like. You can trade your own money and you can have a base income. If you look at it from a purely trading point of view, the decision not to trade other people's money, if you're going to trade for a living anyway, and you decide not to trade other people's money, that's, in my view, a bad trade. You can do the same thing with a much better return profile and a much better risk profile if you trade other people's money as well. So my point with that article, to provoke a little bit, was that to have the dream that you want to sit at home and just trade your own money for a living, that's an irrational dream. The dream should be to trade other people's money together with your own for a living.
Right, I understand. Actually, I like because one of your readers put in nice words that from a pure trading perspective, managing other people's money has the same risk profile as a long call position on your own equity curve, where you also collect the premium as a management fee, as you said.
Yes, absolutely. Absolutely.
Yeah, so that's,
and the interesting money in the business does not come from return on your own capital. I mean, neither Warren Buffett or George Soros became billionaires by compounding their own money.
Exactly.
They both have achieved outstanding. They're some of the best in the world, and they have achieved nearly 20% per year annualized over their career. But 20% annualized, I don't know how much money most people have listening here on how much they could risk on trading, but you try doing 20% over that over 20 years, it's good money, but it's not going to be life-changing.
Yeah.
If you instead could do 12% and you're trading $100 million of other people's money, now you're talking some real return profile.
Andreas, I would like to ask you about the differences between a mutual fund manager and a hedge fund manager. We can see that the majority of mutual funds are beaten, as you also show in your book, by the market year by year. I mean here mostly the stock market. I'm pretty sure that there are a lot of smart people working in that sector. I mean mutual funds as well. Still, they are losing so frequently. Why is that?
Oh, it's not about intelligence at all. I wouldn't claim that people working on one side of the fence are smarter than the other somehow. It's a totally different ballgame. Now, starting with what a mutual fund is. Mutual funds are tasked with following a benchmark, hopefully beating it slightly. But they have a benchmark. The benchmark could be a stock index. It could be a certain percent of a stock index, a certain percent of a bond index. But there is a clearly defined benchmark. And as a mutual fund manager, you have a very narrow tracking error budget, TE budget. That means you're not allowed to deviate much from the index. You can't take much risk. It's just not allowed. What you do is you more or less buy the index. You buy something that will more or less replicate the index. And then you have a small amount, a tiny portion where you can do something with. You can overweight something, upweight something, downweight something, maybe go slightly more in cash at times or go slightly more aggressive at times. But it's a very slight thing you can play with. And
right.
First, it doesn't make that much of a difference. And then you have to add in all the fees. Mutual funds have quite a lot of fees. You have trading costs, you have management fees. It's not surprising, and it's not. I wouldn't even blame the fund managers. Not the people working there in a way. I would blame the system for the fact that generally 85 to 90% of all mutual funds fail to beat their benchmark. You might as well buy a passive tracker. That's what a mutual fund is. Yeah. The other question is actually more complex and more misunderstood. What is a hedge fund? And the short answer is that who knows, really? There's no definition of what a hedge fund is. A hedge fund is some sort of fund which is not a mutual fund. It is not regulated as a mutual fund. A hedge fund can more or less do what they want within the parameters they have set for themselves when they started the hedge fund. But there's no definition of what it is. You could launch a hedge fund tomorrow backed by your stamp collection. You can do absolutely whatever you like, as long as you define up front in your offering memorandum and your documents what it is you intend to do. You follow those parameters. You can do could be anything. I've seen hedge funds backed by wine, bottles of wine. You can do anything. Yeah, as long as you do what you say you're going to do, of course.
All right.
A hedge fund, of course, in general. Sorry, just to mention one last point there, perhaps the comparison that. Generally speaking, hedge funds are absolute return as opposed to relative. That means that a hedge fund is tasked with beating the zero line to make money from absolute perspective. Well, do they in the end? That's a more complex question, but their brief is to beat the zero line, to make money in any type of market condition, whereas the mutual fund manager his brief is to beat the benchmark.
Okay. But is it that hedge funds are, let's say, reserved for more wealthy and more sophisticated clients?
Yeah, well, it's a dangerous term.
Or it's more like you said, the problem of the system, that's how it's constructed, that the majority of us is just offered with the mutual funds aid and may not even be aware of existence of some other funds.
It could be. I mean, mutual funds, everybody knows them. Everybody owns mutual funds, whether you do it directly or through your government pension scheme or whatever it is. But I would dare to say everybody listening to this owns a mutual fund, whether you want to or not, and whether you like it or not, you probably own a part of a mutual fund somewhere. The problem a little bit, mutual fund industry is broken, but it's always been broken. And nobody ever seemed to care, so we keep on ticking. Most people don't understand is that if the benchmark is down 25% and the mutual fund manager is down 24.9%, he did a great job. That's a great success. Yeah. It's not something that's meant to try to be positive when the market is negative. It's a whole different thing. You just follow the benchmark. It would be nicer if it actually could beat the benchmark or at least follow it. But hedge funds are not regulated in any meaningful way. There's some regulations, obviously, but compared to a lot of other things, it's no real meaningful regulation in a larger perspective. Therefore, there is no real consumer protection. You can pitch hedge funds to normal people. There is non-qualified investors, generally speaking. Are they somehow better just because rich people can buy them? Some are, some are not. There are some horrible hedge funds out there, and there are some really great ones.
Okay. Thank you, Andreas, for that. I'd like to discuss with you some topics you touched in your two great books. Both are very beneficial also for someone who would like to run its own hedge fund, but I'd like to focus a bit on the retail side as well. Let's start with the first book titled Following the Trend, Diversified Managed Futures Trading. Why did you decide to write books? Because, it may sound silly, but most of us, on the retail side, they may think like, okay, you are going to reveal some secrets and instead of making money out of it.
Yeah, that's a funny misunderstanding. There are no secrets in there. Why would there be? And besides, it's misunderstanding that there are these kind of secrets to begin with, that they somehow exist. Well, the reason I wrote it to begin with was I was working in this field. The first book is about futures trading, futures trend following strategies, a concept which is very, very well, reasonably well known even in the retail space. There's a lot of myths and a lot of legends around this space. The reason I started writing it was I tried to find good books on the topic. And again, it was a topic I was working in. I was doing well in this field. And I bought a few books on this, and frankly, I didn't find any books that I liked. Maybe I didn't look hard enough, but I didn't find any books that seemed to be written by people who actually been there and done this. I might very well have missed something, so I'm certainly not, accusing the authors out there. But I bought some pretty bad ones, and I thought that this doesn't explain anything. And besides, some of this, they write books that don't say anything, and then they sell some trading systems on their website. And I figured, well, let's try to write a book and describe how this works. I didn't think anybody would pay attention to, what a Scandinavian guy in Switzerland is going to say about a subject, but much to my surprise, it sold quite well and got a lot of attention at the time.
Yeah. Could you please, for those who are not so advanced, explain briefly in simple words your strategy presented in your book? I mean, the trend following strategy. It doesn't need to be very detailed description, but I mean rather some kind of anatomy of the strategy.
Yeah. The first thing I want to make clear is just that when you say my strategy, yeah, sure, I adapted it. But again, there's nothing secret in here, and I don't want to claim that I somehow invented this. People have been doing this for, 40, 50 years, or 40 years anyway.
Yeah.
What I try to do is explain it better, make it available to a broader audience. There's nothing in my book that other people working in the trend-following future space didn't already know. Hopefully I can add some things here and there, but I think I can manage to explain it better than I've seen other people explain it before. So the strategy in general is, the idea with trend following is you look at some market that takes off, something that moves up, for instance, you buy it, you hold it until it stops moving up. And the same thing on the downside, something starts moving down, you go short, that is, you're betting on it to continue going down, and you sit on that position until it stops. That is the general idea. The problem with this is, if you do it on a single market or even a single asset class, you're taking a very, very big risk. Because quite often a single market or even a whole asset class like stocks or bonds, they can go sideways for a long time, and they can go up a bit, down a bit, up a bit, down a bit, and you just keep losing money. What we do in the field, in the business, is we apply a model like this on, first we formulate the rules mathematically, of course, and then we apply this on a very large amount of markets covering all kind of asset classes, stocks, bonds, currencies, commodities. You're trading platinum the same way as you're trading lean hogs and live cattle and the euro and yen, and you're trading everything the same way, which raises the probabilities. And now you construct a mathematical model so you can actually do some scientific analysis on your possibilities or your probabilities of gaining money, and apply it in a completely systematic manner with a mathematical model that leaves little to no manual input, emotions, feelings, anything else.
So the strategy is simple, very simple, but still it shows some solid performance over the years. And you give a real proof that there is no secret entries exit, as most of us could think. But as you said, most important ingredient is the proper money management, risk management, and diversification. But to have a well-diversified futures portfolio and not to take too much risk, what should be our minimum base capital for such kind of strategy?
Oh, that's a problem with this type of strategy, of course. In the futures market in general, you need much more capital. Simply because taking on one single contract in the futures market is a much larger position than one single share in the stock market, to compare there. So if you want to have enough positions to get proper diversification, well, in my view, it is difficult to do with less than $1 million equivalent. Right. Even then you might struggle. Now, There might be other strategies and variations you can do with smaller capital, but sub-million on managed futures is difficult.
Right. Which eliminates most of the retail traders, by the way. But we often hear the stories about traders who manage to grow from 5K capital to millions. Of course, no risk was mentioned. But what would you suggest to someone at the retail side, anyway, who's starting with a small capital? Do you think that it's possible to use some alternative instruments like CFDs or maybe some LEAPS options or ETFs? Is it feasible, you think?
Well, there are clear downsides. I mean, first of all, be very careful with anybody who supposedly made 5 million out of 5,000 in a short period of time. That's especially if they then decided to sell mentoring or other things instead of launching the best performing asset management company the world has ever seen. Extraordinary claims need extraordinary evidence, and if somebody claims that they know how to fly with flapping their wings and just pay me money and I will sell you a brochure that tells you how to jump off a building and flap your arms, you might want to be a little bit skeptical about that. But this type of alternative products, yes, they have some value, but you have to understand the trade-off. To be fair, you can get slightly higher return on small capital. It's a little bit easier to get higher return numbers on, say, a $5,000 portfolio, trading stocks or trading some products suitable for small accounts than it is to have very high returns on $10 million portfolio or $100 million. Still, these products they have some drawbacks. You mentioned CFDs as an interesting one. First, you have to understand what CFD is. There are two very different types of CFDs. There are CFDs on cash instruments like stocks, and there are CFDs on futures. And apart from the name, they don't really share any mechanical properties. They're very different instruments. CFDs on stocks make very little sense to me. I think the main purpose might be to bypass stamp duties if you live in a country which has those.
Yeah.
CFDs on stocks have quite a high funding fee. It's been a while since I looked at that, but you're probably looking at around 10% or something per year in funding fee. So if you just hold a CFD on stock for a year, you're going to lose 10% on just the funding. CFDs on futures are those kind of no fee instruments. Just like when you go to some tourist exchange office and exchange your euro for sterling, and they have no fees on the currency transaction, right? That is, you pay in terms of spread.
Yeah.
So first you have to look at the spread, which is not so easy to model, to build mathematical models on, but that's going to cost you. Second thing is, of course, with CFDs, you have a counterparty risk. One of the great things with futures is that you don't really have that. You're dealing with a clearing house like everybody else. And which individual or which company, whoever it is, who has the other side of your futures contract, it doesn't matter. You'll never know who is on the other side, and it doesn't matter. That's not your counterparty risk. But if you're trading CFDs, your counterparty is your broker.
Right.
So if something big happens there, it's a big market event, and they get wiped out, all bets are off. That's a very different thing. There's a reason we would trade standardized futures with a clearinghouse. Leaps, I really have no experience with, so I'm not going to say much there. I mean, my general comment on options product is that, beware of Greeks bearing gifts, first of all. Second, to use using options for leverage is generally a bad idea. That's the amateur way of using options. Options have a purpose, yes, fine, but to use options just to gear up the risk, it's a bad idea. That's a sucker's game. That's not what is interesting with options. If you really want to get into options, well, step one, study the Greeks. If you don't know what Greeks are, then don't touch options at all. If you're not aware of your sensitivities to various factors, don't touch them. Most professional option traders do not trade delta, they trade gamma or other factors, but be careful with options. They're much more complicated than they might seem.
All right, thank you for that. What in terms of performance we can or should expect from a trend-following strategy in the long run?
Well, similar to what we talked about. I mean, look at large hedge funds out there and look at where the span is. Yeah. I'd say some of the very, very best, some of the really amazing ones, they have achieved something like 18, 19%. But that's very rare.
All right. Okay. But you also mentioned in your book that although the strategy per se is simple, but to run a business as such is not. So even if you have a properly built model and strategy at hand, it's still not so easy to run the business. Could you please explain why?
Well, it's very different thing. I mean, funny enough, I had a question this morning from somebody sent me an email who asking a little bit about starting up some sort of hedge fund business or trading business. And one advice I gave was that most people doing that, they focus only on the trading strategy. Now, clearly you need a trading strategy to have a trading business. But in a way, if you want to be cynical, the trading strategy is what makes you stay in business, not what makes you get into it. First of all, you need the capital. You can't just, if you run a business, you have to have a revenue base. You must have to make a budget. You have to run it like a proper business. So you need a large base capital to begin with. You probably need a seed investor of some sort, and that could cost you a lot. If you have a seed investor who knows what he's doing, he's going to take a big bite out of the business. You have to keep the capital, of course. You have to keep the investors. If you have a bad year and you lose all your capital, maybe you have a great strategy that sometimes have a big losing year, and that could be fine if it's your own money. But now you're running it with other people's money, and you have a bad year, they take out all their money. Next year you have a good year with less capital. And then, of course, you might get more money after your good year. They put money back in, and now you have a bad year again with little capital. And it's much more complicated to run a business than just the trading part.
I would like to ask you two questions about your trend following strategy. I mean, the one which you described in your book and which you adapted to the needs for book. But because as we know, the trend following approach was broadly used. I mean, it was not used for the first time, but it was popularized by so-called turtles in the 80s. And although the core entry exit signals presented in your books are in the same canon as the original turtles rules, you are doing some things differently. First, for example, what I notice is that you are not risking a fixed percentage of your capital by trade, for example, 1 or 2% of the portfolio. You are rather setting a level of maximum volatility a given position may cause during the day. Could you please explain a bit why you're using a bit different position sizing method rather than this, which is known in the public domain since many, many years?
Well, the turtle strategy is interesting. The turtle story is interesting. There's a lot of myth around it, which means you should be, again, very careful, because whenever there's a lot of mythology around something, people stop critical thinking for some reason.
Yeah.
I know some of the turtle guys I got to know after my books and these things. I didn't know them before. I believe they would agree with me that the original turtle rules, in a way, they got lucky. It's an extreme risk strategy, and I do mean extreme risk strategy, which was deployed during a time when this extreme risk strategy worked. Now, if you model these rules, and they've been made public by Curtis Faith some 10, 15 years ago, something, one of the original turtle guys. Yep. If you model these rules and backtest them, you see that there are many times in the past 20 years where you would have blown up your entire account, everything gone, if you had followed those exact rules. So be very careful with, just because somebody at some point made money doing something, it doesn't mean that you can do the same thing today. Also, risk as a concept in the financial world has evolved a lot since those days. I'm sometimes asked this question. You mentioned risk per trade. That term doesn't make any sense to me. That's simply not what risk is in a financial context. Somebody asked me, how much do you risk per trade? What do you mean risk per trade? Per trade a day, or what was the time element here? Risk from a financial point of view has to do with value variation, or rather potential value variation per unit of time.
Right.
It's a very central concept to finance, and something that if you want to trade, you have to understand this concept. The expression "how much do you risk per trade" is nonsensical. What in the next 5 minutes or next 20 years? What are we talking about? Volatility is a necessary component. Some sort of volatility measurement is a necessary component to risk management.
So your perspective is more focused on the portfolio rather than the position.
Yes, absolutely. Slightly different point, but yes, you're absolutely right that what happens to a single position doesn't really matter as long as your portfolio behaves the way it should. I mean,
okay.
Who cares about the position level if the portfolio level is performing?
Okay. And what about another difference I noticed is the lack of pyramiding in your approach. And again, sorry for that, but in this original description of the rules which were used by Turtles, they were using so-called units, and they were pyramiding the position. So once the market was going in the favor, they were adding to the position.
Yeah. Again, this was a long time ago. I don't want to criticize these guys. I'm sure these guys, the ones who are still trading, are not using similar rules. You can see from their results, some of them performed incredibly well afterwards. I'm convinced they're not using the same approaches anymore, or variations of it, probably. Pyramiding, in my view, makes no sense at all. It breaks simple logic. It fails simple logical tests. Again, you're taking a position based on value variation, right? So let's say you buy a stock at 100. Now, after some time, it goes up to 110, and now you double your position. It goes up a bit more to 120, you double again. So the question is, did the forecast somehow change here? Why did you massively increase the risk? I mean, did the probabilities of success somehow change because you got a lucky entrance to begin with? It doesn't make much sense. And what happens if, say, you're supposed to buy at 100, double it at 110, and double again at 120, for instance, and say now you missed the first entrance when the price hit 100. You were out for longer than average bathroom break, and you missed 100. So you come back to the screen, and it's already at 110.
Right.
Now what do? Do you skip the trade? Do you buy one position size? Do you buy double position size? And now you have an interesting problem, because now you have to realize that mathematical finance, it's all about the state of the position, right? Well, I mean, what you have going forward, history doesn't matter. It doesn't impact the future. So if your answer here is you should buy one position, just the normal position at 110, then your logic is totally out the window. If your logic is that you buy the double position size, at least you have some sort of reasonable consistency.
Right, I understand.
But doubling because, probability didn't change just because you entered at 100, right?
Okay, I understand. Okay, thank you for that. Your backtest in the book shows that the transactions on the short side are not profitable, and it's basically a problem with the short positions. Could you please? I'm talking about the short. I'm talking about the trend following strategy. Could you please explain why is the short side such a big problem? Or I don't know if a big problem, but a problem that basically it may happen that on that side you're not making any money, or very not so much money, and majority of your profits are coming from the long side.
Yeah, for most asset classes, the short side is very difficult. Bear markets tend to develop very differently. You tend to have more violent counter reactions. You get kicked out of trends more often. And not all, but most standard type of trend following approaches would probably over a, say, 10, 20 year period make more money if you just skip the short side. The problem with skipping the short side is that if you study the return profile of your strategy more closely, you realize that the return skew, the skew of your returns is improved by the short side. Now, what that means is, say you take the monthly returns, for instance, the percentage monthly returns, and you make a histogram out of it, and then you check where the tails are going. Are the tails fatter on the left side or the right side? Do you tend to have more outside positive returns or outside negative returns?
Yeah.
Clearly, you don't want to have a fat tail on the negative side. You don't want to have large losses, large surprise months on the negative side, but you do want to have those occasional surprises on the positive side with some outsized positive months. And what you realize is that your return skew is improved by the short side. The reason for that is that even if they don't perform well over, say, 10, 20 year period, they do tend to perform well when you really need it. in crisis period.
You presented in your book a very nice application of the modern portfolio theory introduced by Harry Markowitz. Basically, you put a question if a standard long-only equity portfolio could be improved by mixing it with some managed futures strategy, like trend following, for example. And you use the concept of the so-called efficient frontier. Could you please briefly explain in simple words the idea behind?
Well, the idea is that you combine multiple, 2 or more approaches, and you see, can we improve upon, say, the relationship between, depends on which variables you look at. Normally, you will look at the return and the volatility, the return and the risk. Can you improve upon this by combining them? And this is one of the concepts that I really like from modern portfolio theory. You could argue there's a lot of funny things in that if you go into the academic side, but this is something that clearly has a value, that you combine different strategies and you achieve a better return profile than any of the individual strategies could have achieved by themselves.
Right.
And clearly this has to do with diversification, and diversification is something that, everybody should be aware of how it works, and the easy value, if the clear possibility of improving strategies by simply diversifying better.
Right. As you nicely said in your book, that volatility here is essentially the currency in which we pay for returns.
Yeah.
And the efficient frontier helps you to solve that equation. But do you think that it's possible to use the efficient frontier for blending trend following strategies with short-term strategies, for example, counter trend strategies?
Oh yeah, absolutely. But there's a drawback here. From a mathematical perspective, most people realize that after they model quant strategies long enough that you don't need to do it so long to realize that you can improve by, so you have 3-4 slightly different type of trading models, all performing fairly well. If you combine them, you get a better result as a portfolio. Difficult number one with that is, of course, that you generally need much larger capital to be able to do that, to allocate to multiple strategies. It complicates the operational side, obviously, to handle it. But there's also one more aspect that most people might overlook. Right. If you do this on a professional basis, it might hurt your business. You might come up with a better strategy by combining, say, in this example here, you put here with a trend following and counter trend, mean reversion strategies and trend following. You combine it, you might have a better product visually. It has better mathematical properties. But now you go and pitch this to a large pension fund, and they say, well, the CIO at the pension fund is going to say that, you're trying to do my job for me. It's up to me to decide which strategies I buy and at what ratios.
Right.
And now you're presenting a product where you combine different strategies at a fixed weighting. So you're trying to do my job for me. You might lose a deal because of that. So from a business point of view, it might actually hurt you, even though it makes mathematical sense. It might make more sense from a business point of view to offer individual strategies separately and let the client pick how much you want to invest in each.
Okay, I understand. Okay, thank you for that, Andreas. Very interesting. How the right approach to backtesting should look like? Because you quite often point out this in your book that with the backtesting software, especially on the retail side, we can very quickly end up with the funny results, but they will be disconnected from the reality. So how do you see the process of the proper backtesting should look like?
Well, it's a complicated subject. We could probably speak a couple of hours just about that. But briefly, you have to approach it from a scientific point of view first. You have to have methodical approach and not cheat. You can very easily cheat on your backtest, right?
Yeah.
If you use the same data and you keep modeling over and over again, you spend months and months running backtests on the same data, of course you're going to end up with a model that looks absolutely amazing. Whether you do it deliberately or not, you're training your model to the data. Anybody can make a model which has perfect results in the past on a specific set of data. So you have to be careful on how you run your backtest and what modifications you do based on the results you see. I mean, there are some obvious things, of course, like having a different set of data to train the model and to test the result. But you have to be quite strict with this. I would say every time you run a simulation on a set of data, you're decreasing the value of the simulation. You're using the data.
Right.
Say you run the simulation, you realize that we stopped out too early. I changed the stop loss a little bit. Now you run it again, it looks better, right?
Yeah.
But now you already started to destroy the value of the data here.
And do you see any value in periodical reoptimization of the strategy parameters? I mean, here the walk-forward analysis approach.
Dangerous. I know some people who do that successfully. I don't, but tricky. I mean, again, you're risking overfit. You're risking that you keep adapting to the recent past, and that might not be what the future holds.
But you would like to see that the parameters you set, they are more or less stable. I mean, that it's not like you will slightly change one parameter and the whole strategy is not working at all. So that would mean that it's not a useful strategy. So at least you need to know that the surroundings of the parameters you set are also valid.
Yeah. Yeah, I mean, anything that has to do with optimization and changing variables is inherently dangerous. It's not that you should avoid it, just be very careful, because there's always a temptation to over-optimize, and that doesn't help predict the value of the model.
Right, I understand. Okay, thank you for that. Now I have a question which may sound very silly again, but do you think that the trend following is going to die as the market are changing? Because, we hear this story again and again that trend following is not working again because there was a flat year or whatever. Do you think that indeed, because it seems like the times are more difficult for the strategy, which was, for example, in the 80s, but do you think that indeed it's going to stop working at some point or not?
Well, trend following just died, and it just died about, I don't know, every few years it dies, it seems like. Yeah, it's a funny one. The same is said for some other strategies as well, but for some reason everybody likes to predict the end of trend following. You compare with the 80s. Yeah, clearly there's a big difference since the 80s. I'd say the return on trend following models has gone down. Is it still a valid approach to the market? I would say definitely yes. But you have to look at the reasons why returns have gone down. There are two really big reasons. There are a couple of reasons, but a few more reasons, but the two really big reasons which are really the same. Okay, now quite confusing. Let me explain here. So, the main source, the biggest source of returns in the long run, especially back in the 80s, part of the 90s for trend following, has to do with rates, the fixed income sector, fixed income and money market. To be clear, for those not familiar with it, money market means it's not about currencies. Money market is about short-term government papers, futures based on that. So, situation we had in the Western world since those days was we started off with a very high yield situation, and the yield has then slowly been moving down decade after decade. That resulted in two different things, thereby two factors. Back in the 80s, you had very high return, which means you got very well paid for placing money with the government. And a future strategy like trend following, most of the capital you don't actually need. Futures, it's not like stocks where you pay up front, right? You could, in theory, trade $1 million with 100,000. That's not a good idea, of course. So most of us were fully funded, but you don't want to keep the excess money in cash on a bank account. I mean, look at what happened to the guys doing that with Lehman or MF Global. So what you do normally is you place that in government papers of some sort, of varying duration. These days, you don't make money on it. You do it for fiduciary safeguarding only. But back in the 80s, you got a very large return on this money. So maybe you place 60-70% of the fund in government papers, just for safekeeping. And I don't know, what do you get back then, depending on your duration? Maybe you got 8% or something on it. Maybe you got on a fund impact level, maybe 5-6% impact. And you got paid management fee, you got paid a performance fee on that as well, of course, which was obviously quite nice. Being paid performance fee for risk-free interest. This is obviously gone. There is no more free money from the government. Now, the other thing here is, since yields slowly move down decade after decade, trick question for everybody out there, what's the relationship between price and yield? Yes, it's inverse. So,
yeah.
Trend followers basically held government bond futures long on the long side because the price kept going up as the yield kept going down, and you just roll it month after month, decade after decade, and this was an amazing trade. It's not the only source of return, of course, but this was a great contributor for a long time. Those two revenue sources are now gone, at least for now. With the yield levels we are now, we can't expect either one. The other thing we have seen, unrelated problem we have seen, but this impacts many out there, many strategies, is a highly globalized world and a different type of information flow. Everybody looking at the same events. Whether this is a US debt ceiling discussion, some election somewhere, referendum, we constantly have single point in time which changes everything, where everything from the euro against yen currency rate to the bond markets, the currency markets, everything suddenly changes overnight because of a single decision coming out. That is very bad for trend following in general. What we want to see in trend following is uneventful, slow markets. I mean, up or down usually doesn't matter as long as it just keeps ticking.
Right. But you still do trade, I mean, using such approach?
Yeah, I mean, obviously, most people in trend following space had a less than stellar year last year, but hey, that happens. You can't go into trend following and think every year is going to be great.
Yeah.
In the long run, yeah, sure, returns are lower than they were in the 80s, but they still beat stock markets. Nobody says the stocks are dead, and you have to keep in mind that if you compare with the stock markets, in the long run from the stock market, you can expect to have 5 to 6% annualized return, 5 to 6% annualized return over time, with occasional drawdowns of 55, 60%. Yeah. And nobody says that we should simply stop the stock market, right?
What I really liked about your book, I mean, actually in both books, you have the very long chapter which shows year by year how the given strategy works. And it's really very, very interesting. It shows how in reality the strategy works and what you should expect, because sometimes we just only look on the long-term equity line and we think, wow, it's great, we are making money, but we don't see these problems which we have on the way, which is producing this long-term equity line. But it's very interesting to see how in details it works in reality. As you mentioned about the stocks, I will slowly move to the Stocks on the Move, another book which you wrote about the strategy dedicated to stocks market. And you said that it's around 5-6% per year in the long run out of stocks market. But do you think that we can do better using, for example, the strategy you presented in your book, which is the momentum strategy?
Yes, I mean, clearly you can do better than the stock market. The main trick of outperforming the stock market is clearly use some sort of long-term trend filter to make sure you don't participate in severe lasting bear markets. Such a trend filter obviously will hurt you when markets are performing normally. You will underperform if you just buy and hold with a trend filter, you will probably underperform in normal markets, but you will massively outperform in lasting bear markets. So, outperforming stock markets in theory is not that difficult. It doesn't make for the most attractive strategy to do that, but you will beat the market in the long run.
And why do you claim that stocks are the most difficult asset class?
Well, the problem there is you don't have enough diversification. That's why I really like the futures markets, because you have so many different type of markets behaving very differently. In the stock market, sure, you have a very, very large number of stocks. But in the end, they behave more or less the same. Some move up a little bit more than the rest, some move down a bit more than the rest. But particularly when something happens, where there's some sort of event that affects the whole market, then everything moves the same way. So there's no way to hide. This internal correlation in the equity asset class makes it very tricky. So if you build equity strategies, you will always more or less be dependent on the index. You can build strategies that behave different from the index, don't get me wrong, but the success or failure of your strategy will be dependent on what type of market regime, what type of market climate you have at the moment. Therefore, you are in one way or another a bit index dependent. Right,
I understand. You also emphasize in your book that we have to be very careful on the survivorship bias, which is a big trap, especially when we do modeling on the stock markets. And because we can just have a funny results which are fully disconnected from the reality. So this also makes this class of asset more difficult to model, right?
Yes.
Because we need to know, for example, when exactly on the specific day, what was the set of companies in a given index?
Yeah, that's one way to approach it. That's what I did in the book. To describe the problem first, let's say you build a strategy. You want to backtest some trading rules and start off with the current stocks in the S&P 500, for instance, and test that. It's going to look great. I mean, if your strategy is about buying stocks, your rules don't matter much, because you have to understand the reason why these 500 stocks are in the S&P 500. They are only there because they performed well in the past. Right? They're there because there are certain rules about how large a company is to be and so on to be in the index. And how did the company become so big? Well, by the stock price increasing. But it doesn't mean that buying Amazon in 97 is actual strategy. That's daydreaming. Buying Microsoft in 85, that would be a nice strategy, but that's just daydreaming, because back then these stocks were a joke. Nobody would have seriously considered them, especially not buying them then and holding until now. So what you have to do when you model strategies there, when you try to come up with trading rules, is you have to take into account which stocks is reasonable to assume that you could have looked at that time. Which stocks would you have considered if this would have happened in reality? If you would be trading in the mid-90s, what were the set of stocks? And frankly, most of the stocks you would have considered a large part of the stocks you would have considered in the mid-90s went bankrupt.
Exactly. All right. Thank you for that. You also put a point in your book that the trend following doesn't work on stocks, and therefore you gave a special name for your strategy. I mean, special, just a different name, which is a momentum strategy. Could you please tell us about the difference between the momentum, equity momentum strategy versus the trend following strategy?
Yeah. Okay. First, just as before, I just got to make clear that I'm not really claiming to have invented the term momentum in any way here, I made a slightly different version, a slightly different twist on a momentum strategy, but there's nothing revolutionary here. I would say what I add is a better explanation than at least I found before, and that's my motivation for writing it, not for explaining some super secret model, which frankly doesn't exist anyway. But okay, the reason I use a different term, the reason I was quite strict with this terminology, was to highlight the difference. Now, if you want to claim that trend following works on stocks, and your definition of trend following is slightly changed from the normal trend following on futures, that's perfectly fine by me, as long as you understand what you're doing. My point here is that it needs to be done differently, and therefore, to avoid confusion, I tried to emphasize a different terminology. It is very similar in a way. But when you do the equivalent of trend following on futures, you lack diversifications. You can't just run similar type of rules as you can on futures and expect that you could make money in a bear market, for instance, by buying momentum stocks. That's not going to happen. Momentum model will lose in the bear market, for sure.
Right.
And no, you don't want to run a momentum model on the short side with going short the stock that falls the most. That's good luck with that. Good luck trying, but I wouldn't do that. Obviously, there are market neutral type of strategies, but momentum is not a good candidate for adapting to a market neutral type of approach. I mean, you could say you hedge out the index and so on, but you're just going to end up with a beta component. So, I wouldn't do that. So that's the reason I use a different word, just to, again, not my word. It's a commonly used word in the business to talk about momentum in stocks and trend following in futures, but feel free to use whatever word you like as long as you understand what the concept is about.
Yeah, but could you please, on a very high level, describe the momentum strategy you put in your book? I mean, of course, avoiding terms like exponential regression or coefficient of determination, because majority of our listeners will switch us off right away.
Well, you just said it, so I guess we lost them. Now, the idea is this. You want to find stocks that are moving up strongly. And the theory is that when something has been moving up strongly for a while, it probably continues strongly up a little bit further. At least it has slightly higher probability of continuing up than simply dropping back down like a stone. That's the general idea. And now you have to find some sort of mathematical measurement for how do you locate which stocks are moving up the most. And what I did, without using the mathematical terms here, I tried to find a way to measure not only how much it moves up, but under what kind of volatility. I like stocks that move up in a reasonably smooth manner, not something that moves sideways for a week and then doubles and moves sideways again, to have the extreme example. Right. As smooth as possible.
Okay, understand. And you said also before that the stock market in the long run gives us around 5-6% return. What about, and this is just passive investment, so we just invest in the stock index, for example. But how about this kind of strategy? How we can beat the market?
It's hard to say what's realistic in terms of return, but you can achieve higher by using this type of methods. How high? Well, at least in the past, I try to be careful with saying these are simulations describing the past. I'm teaching the concept how to do it. I'm not, the usual disclaimer. I'm not recommending any specific way of trading in the future, but here are models which have worked historically, and here are the reasons for it, the details how it works, and that's what I try to add. I mean, clearly the problem with the stock market, the big elephant in the room, are the massive bear markets, and we had two of them, two really big ones in the past generation. Current generation has seen two really big ones. If you manage to avoid them, or at least reduce the impact of them, you already pretty much doubled your return over time. So we saw twice the market lost about half. Then, of course, you can argue on the other side that curve fitting. We have two events. We can very easily slap a 200-day moving average or something on there and avoid the drawdowns. But are we just curve fitting to two observations here? Does it have predictive value? And then you get into a philosophical discussion. So, as long as you understand the arguments on both sides here and what the risks and possibilities are.
Right, I understand. Do you think that momentum strategy for stocks could be improved by using leverage? I don't know. I mean, margin accounts or stocks futures?
I don't like leverage. I mean, not as just to increase risk. You have to look at your possible drawdown, and let's say you have a strategy which occasionally has in a backtest occasionally has a 30% drawdown. That's normal. So you have a strategy that over time in a backtest has, say, 15% return, occasional 30-35% drawdown. Well, first, that means that probably if your worst situation in the backtest was 30% drawdown, you're probably going to see a 40-45% sooner or later, right? Because the market is not going to be too friendly. Once in a while, something will happen your backtest is not prepared for. Part of the game. Maybe you can survive a 45% drawdown. Maybe. But now you put on leverage and you trade with, say, double risk. And now you had a 90% drawdown. Yeah. Now you have 10% of your capital back. You're not going to come back from that. That's a career-ending move.
So talking about the risk, you emphasized multiple times in your book that risk parity is very important. And in the context of the momentum strategy, could you please explain the term? Because it maybe sounds very strange, but it's a simple thing.
Well, weighting in general is very important. There is how much do you allocate to each position. I am not a fan of the term money management, mostly because most you hear about so-called money management has to do with pseudoscience and numerology or worse, some Las Vegas blackjack strategy type of things that really don't belong in finance. But how much you buy per stock or per position is important. First, you have to realize that one reason that the stock market performs so poorly, not just the bear market, as I mentioned before, but is because of the extreme concentration. Now, the S&P 500 has 500 stocks in it, but you can cut out you can delete the smallest 200 stocks in there, 250 stocks, and the index is going to look pretty much identical. Because the top 10, 15 positions alone can more or less replicate the index. They are massive positions compared to these tiny, tiny, tiny ones in the end. There's no real diversification there. So, I mean, you asked me how to beat the stock market. Look at the equal weighted strategy. There's an ETF out there, or several, I think, on that as well. If you buy the same amount of each stock in the S&P 500, for most periods of time, you would have beaten the market just by owning the same amount of each stock. In my view, an even better approach is the so-called volatility parity, which is not at all as complicated as it sounds. Vola parity is about targeting approximately the same amount of risk per position. Risk is a dangerous word, it's a complex topic, but let's use volatility as a proxy for risk here. So what you do here on the conceptual level is you look at how much volatility does each stock have? How much does it tend to move up per day, back and forth? What's the standard deviation, for instance, of it? There are a couple of ways of measuring it, but say you check standard deviation of all stocks, for instance, to see how much it swings. And now you buy more of the stocks that have small moves and less of the stocks that have large moves. That makes each position, you let each position have an equal possibility to impact the bottom line of the portfolio. As an example, look at what happens if you don't do that. If you buy the same amount of each stock, and one of these stocks is a slow-moving telecom company that moves 0.3% per day back and forth and not much happening. Another stock is a biotech that can easily go 5-6% per day up and down. If you buy equal amount of these two, the position of the slower moving stock doesn't really matter, right? The entire portfolio will be driven off the swings on the volatile position. But if you instead buy a much smaller position in the volatile biotech stock, they both have an equal chance at impacting the portfolio.
Right.
And generally you tend to see, not always, but generally you tend to see performance enhancement by volatility parity approaches.
Andreas, provided that someone was able to implement the strategy you showed in your book, which may be quite tricky if done not on the professional side, do you think that such approach is more accessible to trade for a retail trader in terms of the capital requirements?
Yes, of course. I mean, this is the advantage of stocks versus futures. Futures are not meant for retail. Futures contracts usually has quite a large face value, sometimes in the hundreds of thousands of a single contract. On the stock level, of course, you can buy a stock for, depends on the price, you can buy some stocks for $30. That's all it takes. So yes, of course, you can implement much more complicated systematic portfolios and other type of portfolios in the stock market with smaller amount of cash.
Right.
More accessible.
Right. Okay. I think that's it for the stock momentum strategy, and I've got a few final questions.
Sure.
Do you have any plans to write a new book?
I do actually. The problem as always is writing books is, I'd say that's a hobby. It's not a business. It's a hobby, and hobbies always take a backseat to actual real business. Right. I do have a manuscript at the moment in front of me on my computer. I've been on and off working on for a long time. At one point, I had 500-600 pages. I wasn't happy and deleted most of it and started over. I think I'm up to about 400 pages again. But yeah, I'm hoping to complete something here. At the moment, this manuscript is it's a very practical book on how to use Python for backtesting, how to get up and running, how to get it installed, how to get everything working, get the data working, as well as detailed source code and how to build multiple trading models, explaining what they do and why they do it, and so on. That's what I got at the moment. And unless I wake up one day and think it's crap and delete it and start over again, that's probably what the book is going to be. So the plan is to get that done within the next half year or so.
You said it's more like a hobby, but I saw that Stocks on the Move you self-published, and I'm talking about this here because my country of origin is Poland, and I can tell you one story which may be interesting to you. Namely, we have there extremely popular, successful blogger who writes about personal finance. His name is Michał Szafrański, and around mid of 2016, he self-published his book in that topic. I mean, around the personal finance. And since then, in less than 3 years, he sold already around 70,000 copies, which generated him around $2 million so far. So just amazing. So, from hobby, you can make a great business as well, even selling the book. That's just an example I can share with you. You mentioned about the Python. Why did you decide to learn Python while you are still working, as far as I know, with the right Edge in C#?
Yeah, let me just a brief comment since you mentioned. I don't know this guy at all, so I have no comments on at all on this situation. But books in general, extremely few people. I do mean extremely few people make any sort of meaningful money on selling books on finance. I am aware of one person in mainstream finance books. I mean, the self-help books is a different thing. If it's personal finance, self-help book, those have a mass appeal. You can sell large amounts.
It's a broader audience.
Yeah, that's if you can do a book that can be sold as an impulse buy at airports, then lucky you, because that's going to sell. As far as I know, and I spoke to. Well, my publisher of my first book claims that I'm in the top 1% of best-selling authors in the field in trading books. And if that's true, then it's a pretty sorry state of affair. I mean, it's a hobby business, I would say. It's not meaningless money, but it's a hobby. As far as I know, there's only one person in proper finance books who is making serious bucks, and obviously that's Michael Lewis.
Right, of course.
If he can be called finance author anymore after branching out. Also, regarding self-publishing, I just want to comment on that since you brought it up. If there are people out there considering writing books, you might wonder, why did I first publish with one of the largest publishing houses and then self-publish? It's a weird situation with books these days. 20 years ago, you needed a publisher. The question is, do you need one now, other than to put a log on your book? Yeah. It's an interesting question. People would think that if you publish with a large house, it's somehow vetted and controlled, and they have a team of experts who check everything. And of course not. Or you might think it's extremely difficult to get approved to be accepted by a publishing house. And no, it's an industry in crisis. They'll take anything you throw at them. As well as, of course, most of the revenue. So as a businessman, I got a bit disillusionized with how much publishing houses take out of the revenue and how little is actually done. And therefore, I self-published as an experiment. And after that, I would say that self-publishing seemed to be the way to go for now.
Right.
Sorry, your question was regarding Python. Let me get back to that one.
Yes, because you mentioned that you are preparing something regarding Python. So my question was why you are moving, not moving, apart from C#, you also put Python in place.
Yeah. Python is in many ways the superior language for this. It's not as fast. If you're reliant on high speed calculations, Python can be reasonably high speed. Not the fastest. It can be reasonably high speed, but you have to be very careful how you write the code if you need speed. But the nice thing with Python is that with some additional libraries, obviously pandas, some other things. You can get things done extremely fast. I mean, tasks that, some things that it would take me a day to write in multiple classes and build a whole structure of things in a C-type language. Suddenly you write it in like 5 lines of code and it's just done. I was a bit shocked when I first started learning Python of just how cool it is to use for time series analysis, mathematical finance. It is pretty cool. Mm. There's some drawbacks, of course. It is there's no user friendliness whatsoever. Forget about manuals. Error messages, well, they're pretty much built by some sadist who's trying to make you, tear your hair out. Lucky for me, I have no hair left anyway. It can be very frustrating to get into, but once you start learning it and appreciating it, it is a very cool environment.
Right. I understand. So apart from currently, because you're still using C#, apart from these 2 languages, are there any other languages you're using for your modeling?
Not for business logic, no. I use other languages for convenience at times. I mean, say, for instance, maybe I build some in-house tool. I kind of enjoy building these kind of things. It gets me away from, do some different things at times as well. Maybe I build some cool, in my view, fun, cool tool for analyzing a backtest or evaluating other hedge funds for allocation, something like that. And Python in general has a very poor user interface possibility. So right. I might use, say, a JavaScript HTML active web page, build an in-house website, which visualizes everything nicely, build a GUI on it, and now is usable, and other guys in the office can actually use it, as opposed to having, just a text editor and some code to send around. So if you really get into Python, then it's quite useful to know a bit of HTML and JavaScript as well. And lucky me, I've been doing that for 20 years anyway. So yeah.
Yeah, sure. Is your trading fully automated? I mean, are you transmitting your orders manually or it's done all automatically?
No, I'm a paranoid guy. I don't like to have code send things to exchange. I'm not saying it's a bad idea, but it's not what I want to do. I want to have somebody eyeballing it, verifying it, trading in and out manually based on, proper execution trader.
But of course, based on the output from your models.
Yes.
Of course. And what was your biggest lesson in trading? I know it's very often the same question repeatedly asked, but do you have any lesson which you remembered very well regarding trading from your past?
Oh, probably. It's just one of those things that's hard to come up with on the fly. I mean, in general, you learn more from crisis than from success.
Yeah.
If I would pick something, I would say 2008, say around October. Mm-hmm. That was a valuable lesson. Total crisis mode, like everybody else in the world. Those days, I'm not sure if you were trading back then, but
yes,
there was a while where by the end of the business day, you have to do an analysis of which of the world's global banks is least likely to go bankrupt until tomorrow morning.
Yeah.
And move counterparty risk between banks. I mean, back then, this was ridiculous, the stress level of this. I mean, this was a very good year performance-wise for us in the trend following business, but none of us wish it ever happened again. You can imagine at the end of every day, you analyze. We look at Goldman Sachs, Deutsche Bank, ABF AMRO. You look at all the big players at the time and try to figure out which one is least likely to go bankrupt by tomorrow morning, and then we move counterparty risk to those overnight.
Right.
Tomorrow we make the same decision again. Tomorrow we reevaluate. That was stressful times, and that's it's a valuable lesson in what can really happen when things go wrong.
Yeah, and I think that most often majority of us don't think about this counterparty risk that we can lose not via trading, but just simply our broker will blow up and our money are gone.
Yeah, not just a broker, your actual bank. It's one thing if your little stockbroker, if your online broker blows up, yeah, sure. But if it's a big global bank with, tens of thousands of employees, well, that could happen back then.
Because, people, they think or they thought that banks, they just cannot collapse. But 2008 was a different reality, and it proved it being wrong.
Yeah, banks are interesting. I had a friend some time ago who were part of starting a successful bank, and he once told me over a drink that bank robbers are amateurs. Professionals start banks.
Do you have any favorite traders or mentors?
No, not really. I mean, I have a lot of people I respect in the business.
Right.
But I think it's very dangerous with this hero worship. Again, as I said earlier, I come from the retail point of view to begin with. I mean, it was 25 years ago, but still. And most of us, we read these books, we read the Market Wizards, and they're excellent books, by the way, but most seem to think that they should pick someone somebody they really don't know much about, except some interview somewhere or, some silly podcast somewhere, and somehow emulate them and look up to them. And that's a bad idea, Just because somebody had success in a certain way doesn't mean that you can do the same way. You might have to find your own way. Because something worked 20 years ago doesn't mean it works today, and it's hard to know. And
and also we have survivorship bias here, because we are talking about these people who are successful.
Yeah, sure.
And we are skipping people who just lost, and they are not mentioned. So
yes, and there's always the usual danger: never meet your heroes. There's a lot of people in the industry that I really respect. Some that back in the 90s you would have thought were the best, the coolest traders in the world. Some of them were. Some of them, after meeting, talking to them, learning about the product and so on, some really are, and some are really not. And you can't really figure that out from reading books and interviews or podcasts. And it's a dangerous thing with hero worship. Find your own way. Listen to information here and there, take your own things, and do your own thing.
Yeah. Andreas, thank you so much for being here today with me on the show. I'm sure that you provided lots of value to everyone. Just before we quit today's interview, is there anything else you'd like to add?
Well, I'm looking at, you were kind enough to send me a paper with some of the questions here, and I just saw the last one on your paper has said something about favorite book.
Yes, please go ahead.
I just thought I'd plug it again because I think it's actually one of the best books in the topic written, and I should start charging this guy because I plugged his book a couple of times before.
Right.
Rob, you owe me another beer next time. But Rob Carver's first book, I think, should be mentor reading for anybody who wants to get into systematic trading. It's let me see his first book, I believe, is just called Systematic Trading.
Yes.
Yeah.
Yes. Great book
by
indeed.
Robert Carver. Yeah, it's a good book.
Yeah, and he explains pretty difficult things in a nice way.
Yes, and realistic. That's the important thing. I mean, you can see when a book is written by somebody who's actually been there, or some cowboy who really hasn't been there.
Mr. Carver is also a big fan of Python language, programming language.
Yes, that's true. Yes.
Yeah. I can say also that, honestly, and I'm not paid for that, I can recommend everyone books written by you, Andreas.
Thank you.
They are also very well written, easy to understand, and full of value. They are very, very practical, although it's not easy to implement, so there's no free dinner, and properly use strategies described there, but they are really very well written, so I can absolutely recommend it to everyone. And as I said, I'm not paid for that, but really very great books.
Yep, appreciate that.
Thank you, Andreas. So, is there anything else you would like to add? Or?
No, that's all far from my side, and I hope I managed to contribute something useful to somebody out there.
I'm very sure that you provided lots of value for everyone here, so I'm very grateful for that. Thank you very much, and have a good day.
Thanks, you too.
Thank you. Bye-bye.
Bye.